All right, well, good afternoon or hello. Going to do some exercises together on the current chapter. Just to find my list. Chapter 6, where we're looking at financial statements and shareholders' equity sections, et cetera, of corporations primarily, where they have shares, et cetera. So let's walk through. On my screen, you should see question 1A. This is chapter 6 from the workbook. If you have the physical workbook, it's page 222 if you want to follow along. And what I'll do is I'll just walk you through how these solutions have come together, just to help provide some commentary, if that's helpful. So this first question is around this company that had sales of 400,000, cost of goods sold of 120. Let's zoom in. For the year ended December 31st, 2020. And we're actually told what the selling versus admin expenses are and what the tax rate is. So in this case, just like every other financial statement, we have GLE Corporation income statement for the year ended December 31st as our headings. Sales revenue 400, COGS gives us a gross profit of 280,000. We then, because we're just told total selling and admin, we don't have any details. So in this case, we'll have operating expenses split between selling and admin for the 80 and 20, totaling 100, giving us $180,000 of income from operations. We're not told of any other income from discontinued operations. We will have an example of that later. And then we calculate the tax of 30% of the 180, giving us $54,000 in tax for a net income or loss of $126,000. So hopefully that comes together, hopefully fairly straightforward. Again, that's following ASPE in this example. Let's go down to question number 3 here. Question number 3 says we're given some information from their accounting records as of May 31st, and they prepare their statements in accordance with ASPE. We're told to assume a tax rate of 37%. So in this case, that doesn't really matter. So we have the statement of retained earnings. We're told the opening balance from the year prior being 110,000. We're told net income, which should be after tax, of 156. And then our cash dividends we would subtract in 61. So our closing retained earnings would be 205,000 as of May 31st, 2020. Obviously, net income is after tax. If this said net income before income taxes, well, then you would subtract the 37% accordingly. Let's move on to question 4, where this company, Top Cuisine Inc., has a March 31st year end. We're told a number of components, and we're asked to prepare the statements of retained earnings for 2 years in 2020 and 2021. So for 2020's statement of retained earnings, we would start with the opening retained earnings as of April 1st, 2019. We're told it was 54,700. Net income for 2020 was 24,615. Cash dividends were of 12,600 were declared and paid, giving us closing retained earnings of 66,715. That becomes our opening for the next year. The next year, we had a net loss of 16,680. So we'll have subtract or less net loss. And dividends of 10,400 were declared but not paid. But yet, once they're declared, they reduce retained earnings and going into a dividends payable account as a liability. So we subtract them from the statement of retained earnings. That gives us a closing retained earnings as of March 31st, 2021 of $39,635. Let's scroll down to question 6. Actually, I'm going to hopefully split screen a little bit here, just to have more on the screen at the same time. Okay, so we have question 6, where we're given some information about this company, Sigmund, and we're given the following account balances as of 2020, and we're asked to prepare the classified balance sheet under ASPE. So first of all, we need to split between assets and liabilities, and then also between current and long-term. So we have a list of items, and we're also told additional information at the bottom. So hopefully the asset side is pretty straightforward. We've got cash, we've got accounts receivable, we have some inventory and prepaid rent, no prepaid insurance or anything. So we have total current assets on the right-hand side here of $142,000. We look at our property, plant, and equipment, which is our cost 220 less the accumulated depreciation of 8,600. So we present a net book value in this case of 211,400 for total assets of 353,400. Going into our current liabilities, we have our AP of 56,000. Okay, so we have 56,000. We have unearned revenue of 3,500. And then we have, do we have a current portion of any bank loan or note payable? We do have a notes payable 110,000. That's where you need to look at this additional information where it says it's repayable for 4 years and 27.5 will be paid within the next year. So our current portion will be the 27.5 with the balance being long-term 82.5. And if we look at our list, there are no other long-term liabilities. Our total liabilities in this example would be $169,500. Then to display the shareholders' equity section, you first of all start with your contributed capital, which in this case are your share values. And then you need to disclose how many are authorized versus how many are issued. So first of all, we start with preferred shares. They are cumulative, we're told. They're at $5 annually, so cumulative $5, 10,000 shares authorized, we're told, 5,000 issued and outstanding, and it's worth $50,000 as per our trial balance. Moving on to common shares, it says unlimited number of shares have been authorized and 2,000 shares that are issued and currently outstanding. They're worth 42,000. So our total contributed capital will be 92. Last item in this shareholders equity section then would be our retained earnings, which we are told is 91.9. So our total liabilities and shareholders equity would balance to our assets of $353,400. We're going to move down to question 10A. Okay. All right, so 10A, again, we're given a bunch of balances and we're assuming a tax rate of 20%. We're going to exclude the earnings per share presentation. Okay, so we're just going to create the statements as required without the earnings per share component that we talked about in this chapter. So firstly, we need to identify our comprehensive income statement. So I'll pull it up here. And this is by nature of the expenditure. So we'll start with our sales revenue, which starts with 520 less any returns and allowances, no sales discounts. So we have our net sales revenue of 516,100. We have our cost of goods sold in this case, 234. So we have a gross profit showing of 282,100. Then we move on down to our expenses. So we have our salaries expense, our advertising, our rent, utilities and supplies expense, showing our operating profit is 142,200. Then we move down to interest expense, which in our case we'll call finance costs, 2,700. Then we have a profit before income tax of 139,500. Apply a tax rate of 20% to that would give us income tax expense of 27,900. So the profit for the year from continuing operations of 111,600. Then we move on to profit for the year from discontinued operations. So here we have 16,800 less the tax rate of 20% gives us net of 3,360 at tax being 13,400. So that's 16,800 times 20%, 3,360 in tax. Then we have a loss on sale of discontinued operations as per our list here of 5,700. And then we'll get some tax credit back at 20%, we're assuming. So that's a tax credit back of 1140. So for the net loss after taxes would only be 4560. So our profit for the year, you would add the 111.6, the 13,440, and the 4560 to give us profit for the year of $120,480. Then we have OCI, other comprehensive income net of tax. So then what we're not in the business of is foreign currency translation would be considered OCI. So in this case, we have a loss on the foreign currency translation of $600. There would be a tax recovery of 20% on that being 120. So our total loss actually is 480, resulting in total comprehensive income of $120,000. Moving on to the next part is we're asked to prepare a statement of changes in equity under IFRS for the year ended December 31st, 2020, and the beginning balances of retained earnings and the accumulated other income accounts are $90,000 and $1,000 respectively. Spader Inc.'s common shares had a balance is $400,000, and they were unchanged throughout the year. The company declared and paid $30,000 of dividends in the year. So we'll set up our statement of changes in equity. We'll have different columns for the components of equity. First column being common shares, then retained earnings and any reserves. So we have $400,000 as our opening balance of common shares, we're told, $90,000 of our retained earnings, as we're told, and $1,000 of accumulated other income, for a total equity of $491,000. Our profit for the year, we had if you go back to our comprehensive income statement, $120,480 in comprehensive income for the year, so that goes to our retained earnings. And the $480 loss on foreign currency goes to the other reserves. Then we have our dividends declared and paid. So dividends declared, they reduce our retained earnings of $30,000. And therefore our balances across the different components of equity, $400,000 in common shares, $180,480 in retained earnings, $520 in reserves, for a total equity of $581,000 at the end of the year. All right, let's go down to question 11. Just gonna get this all on screen here. All right, so in this case, we're given the adjusted trial balance for a company. As of September 30th, 2020, we're assuming a tax rate of 40%, and we're excluding EPS, earnings per share, at this time. So we're asked to prepare a multi-step income statement. A multi-step income statement shows the details of sales versus net sales. It shows COGS, gross profit, your operating expenses split and detailed out for selling and admin by major object. And then you have your other income and expenses and any discontinued operations at the bottom. So we'd have to go through the adjusted trial balance to identify what should appear on the income statement. So once you've gone through this list and identify, okay, that's a revenue, that's an expense, that's other income, and that's discontinued operations, it would then look like what's on the right-hand side of the screen. So we'd have our gross sales revenue of 115, less sales returns and allowances, less sales discounts, okay? Net sales of 100,490. Our cost of goods sold, we're told, is 40,250, matches there. For a gross profit of 60,240. Then we identify what are our selling expenses, so anything that allows the customer access to our products to purchase. So we have our store equipment, it's what holds the items for sale. We have advertising, because that's to try to reach our customers. We have our retail space, and we have sales and salaries. So total selling expenses were 60,750. On the administrative side, we have depreciation expense of the office equipment. So we obviously have an office for, maybe it's payroll and accounting. We have rent expense for the office, and then we have office salaries expense. So those that are kind of behind the scenes. Total admin of 23,470. Total operating expense 84,220. So now we have a loss from operations at 23,980. Then we move on to other income and expenses. So in this situation, we had a gain on sale of assets of 2530, and we had interest expense of 5520. So that gives us 2990. So that gives us an income or loss from continuing operations before income tax benefit or expense. So it's a loss of 26,970. And then the income tax benefit in this case, because we have a loss, is 40% of that, being 10,788. So 40% tax rate. So we have an income, actually technically a loss, but the line is called income bracket loss from continuing operations of 16,182. And then do we have any discontinued operations? We actually have a gain on sale of discontinued operations here of 13,400, but we need to net that of tax, recovery of 40%. So we take 60% of that, gives us 8,040. And we disclose what the tax is here. We also have a loss from operating discontinued operations, and net of tax is 17,400. So the loss was 29. less 40% being 11,600 in income tax you'll get back. So therefore, our net income or loss, including all operations, discontinued or not, is a loss of $25,542. Next part says, the balance of retained earnings in the adjusted trial balance represents the beginning balance. No dividends were declared, and let's prepare a statement of retained earnings. So we have our retained earnings of $35,512, pull it from the adjusted trial balance. We have our net loss that we just calculated at $25,542. So our closing retained earnings as of the end of the year, September 30th, 2020, would be $9,970. Part C says prepare a classified balance sheet, and we're assuming they use ASPE. We're also told the note payable is due over 4 years. Principal payments are $10.50 a month. Preferred shares are 10%, 55 to authorized, 50 are issued. 55,000 are authorized, 50 are issued, and common shares 100,000 are authorized, but only 1,000 issued. So just like the previous example, we'll walk through our trial balance, identify what are assets versus liabilities to start with, and then we'll talk about equity. So we have cash, AR, inventory, and prepaid insurance. Okay, so this is in alphabetical order, so you have to be careful and pick out the right ones. Total current assets would be $76,475 plus our property, plant, and equipment net. So if we look at our property, plant, and equipment, let's see. Sorry, I just lost it. We have our depreciation here. Where is our? Sorry, where's our? Oh, there's our accumulated depreciation. There we go. So 50,600 less the 8,050. I was going blank for a second. Gives us a 42,550 net. Total assets of 119,025. Breaking out our current liabilities, AP, unearned interest payable, and salaries payable. They're all current. Then our notes payable portion, it'd be 12 months times the 1050 per month that we're paying. So that would give us 12,600. Total notes payable is 46,000 though. So take the 46,000, subtract the 12,600. That'll give you what's remaining as considered to be long-term portion, 33,400. Total liabilities, 103,055. Then we look at our contributed capital, preferred shares, we're told 10%, 55,000 authorized, but only 50 issued, and they're worth, according to our trial balance, $5,000. Common shares, 100,000 authorized, 1,000 issued and outstanding, worth $1,000. Total contributed capital of 6,000, plus the retained earnings from the previous schedule of 99.70. Gives us total shareholders' equity of 15,970, balancing our liabilities and shareholders' equity to assets of 119,025. Next part says, now let's go through the example of what would their statement of financial position look like if it was under IFRS. So basically we flip the order of things. So we would start with long-term assets, the PPE net, then we go current assets. Basically it's upside down. Okay, otherwise very similar information. Preferred shares, common, then retained earnings. Liabilities start with the long-term portion and then the current items, same balance. Then we say, okay, what happens if Sandstone had accumulated other comprehensive income or reserves with the credit balance? How would it appear on the company's statement of financial position? And does it differ? So accumulated OCI or the reserves account would be reported below retained earnings in the shareholders' equity section. Okay, so it's a separate item in the statement of financial position under IFRS. Okay, so it would be just right up in here. And AOCI doesn't exist under ASPE. Under ASPE, you would not record that. So it would not exist on your reporting. All right, so let's move down to question 14. Pull it up here. Zoom in now. So question 14 then looks at Rocket Corp. They have 42,000 common shares outstanding, and that's on January 1st, 2020. And on March 1st, the company issued 20,000 more common shares, no preferred shares outstanding. And for the year end 2020, assume that Rocket Corp had earnings of 600,000. So first of all, we need to do our weighted number of shares. So as of January 1st, we had 42,000 shares. That was for the full year. Then on March 1st, we issued 20,000, and those shares were held for 10 months of the year. So we'll take 10/12 of the 20,000. That gives us a weighted average number of shares for the full 12 months of the year of 58,667. Now we're asked to create and calculate the earnings per share. So in this case, we'll look at the earnings per share of 600,000. There's no dividends. So we'll have 600,000 less nothing divided by the weighted average number of shares of 58,667, giving us an EPS of $10.23. Last question I'll just review together with you is question 16. The following data is available for two different companies, Sam and Tally, for the year end 2020. We're given a bunch of info. It's on screen here. So we're told that Sam has 100,000 shares and Tally has 50,000 shares outstanding throughout the whole year. Neither company has preferred shares. So we're asked to calculate the earnings per share. So we'll look at net income, subtract preferred dividends, which we don't have because we don't have preferred shares, divided by the weighted average number of shares outstanding. Okay, so we look at our net income, 830 divided by the 100,000, be $8.30, versus 570 divided by 50,000 is 1140. Then we're asked to calculate the dividend yield. Dividend yield is equal to cash dividends per common share divided by the market price per common share. So we've got dividends of 200,000 for Sam, divided by the 100,000 shares, divided by the market value of $14 we're told up here. So that's 14.3%. Versus Tally Corporation only paid 120,000 because that's over 50,000 shares divided by a market price of 11. So their dividend yield is 21.8%, quite a bit higher. So our price to earnings ratio, then we look at our market price of $14 and $11 respectively for Sam and Tally, divided by the earnings per share of $8.30 and $11.40 each. So our price to earnings ratio, Sam is $1.69 and Tally is 0.96, just under $1 per share per price. Sorry, yeah, $1 each for a price to earnings ratio, not per share. So now we want to compare the performance position of those two companies by looking at those ratios. The earnings per share ratio is an indicator how profitable are they compared to the number of shares that are invested. And so it talks about how much earnings belong to each share of the organization. And the EPS is better for Tally than Sam. So that might tell you that Tally is more profitable. Okay, but you have to look at other ratios. It's not always just the EPS. The second one says that Tally's dividend yield is 21.8%, and it's much higher than Sam's dividend yield of 14.3%. So maybe Tally could afford to pay a higher dividend per share than Sam, because of their higher EPS. But also, the market price is relatively lower. So maybe Tally shares are currently undervalued. Lastly, the price to earnings ratio is higher for Sam, though. It means that the shares are selling for 1.69 times the earnings. An increasing price to earnings ratio might not mean that it's more attractive. Shareholders might react negatively to a higher share price and sell their shares, which then would cause those share prices to fall. So in my opinion, Tally seems to be the better one to invest in at this point. Higher dividend yield, higher earnings per share, and the price to earnings ratio is closer to 1. Okay, so that's all we'll do today. If you have any questions, feel free to reach out. Take care.